a question about the UK. Why is the UK downgrade bigger than other major economies? What can we do about it? And you say in the forecast that you expect the impact of rising energy prices to linger in the UK. Why is that?
Okay, any other questions on the UK? Don't worry, we will get to more rounds. I'm just trying to be as effective as possible.
Yeah, Alex Brummer from the Daily Mail. The UK has a history of wage price inflation, and indeed there are industrial disputes going on at the moment in the National Health Service. I just wondered if you fear that the UK could be back into a wage price cycle of the 1970s.
And before you answer, Pierre-Olivier, we have another question from Tim Wallace from The Telegraph, also saying, please, can you expand on the reasons for the UK downgrade?
Yes, very happy to do that. So on the UK downgrade, we have, the UK's numbers are revised down for 2026 by 0.5 percentage point. So we're projecting a growth rate of 0.8%. Now, there are two main reasons for this. The first one is the war in the Middle East, of course, and I'll expand on that in a minute. But there is also the fact that there was a relatively weak performance of the UK economy in the second half of last year. And the way the numbers are computed, there is what we call a carryover. So there is a kind of a shadow effect of that growth into 2026. And that also contributes to a lower growth number overall. But there is an expectation of a rebound in 2027, and growth is expected to be at 1.3%. Now, the impact of the war in the Middle East for the UK is, of course, coming through energy price, and in particular gas prices. And the UK is highly reliant on gas for its energy mix. Now, a lot of this gas is produced domestically, but there is still a part of it that is imported, and the part that is imported is at market prices. It's much more expensive, and that kind of sets the price for energy in the UK in an environment in which gas reserves are relatively low when you compare them to other European countries. So there is more of a pass-through, if you want, of gas prices into wholesale prices of energy, even if households are protected temporarily because there are some measures in place. So there is an impact of the developments in the Middle East and disruptions in energy markets in the UK. Now, even we're revising up inflation for the UK as well. Headline inflation, we're expecting 3.2% next year. But we're not moving very much our estimate for core inflation. It's expected to be above 2%, but only marginally up from what we were projecting in January, around 2.7%. And the reason for that, and that's how I'm getting to the question about the wage price spiral, is the UK economy still has a negative output gap in our estimate. So there is quite a bit of slack, and that actually is moderating some of the wage pressures. Now, we'll have to see and watch how the increase in energy prices, especially when they get to consumers, whether that translates into a different dynamic. But right now, there is little evidence that there are strong wage pressures in the UK economy, and therefore, under the reference forecast, our estimates of core inflation are not increasing too much.
Okay, we have a question regarding Europe that comes from Gianluca di Don Francesco Il Sole 24 Ore. Will it be right thing to do for the EU to put on hold its Stability Pact? That's one. Any other questions regarding European countries in the room? I'm going to go to the gentleman there.
Yes, Hugo Dixon, Reuters. I have a question. Have you done an analysis of if there are tolls on the Strait of Hormuz, whether that will be primarily absorbed by the consumers in Europe and elsewhere, or by the producers?
I think we can go ahead.
Right. On the question of the EU Stability and Growth Pact, I mean, our assessment is that a number of European economies really need to rebuild their fiscal buffers, bring their deficits, especially their structural deficits, down. And they are on their way to doing that under the EU rules. It's a multi-year plan, so they have objectives in 2029, 2030, 2031. They don't do it in one go, but they are on their path to get there. And it's very important to stay the course. It's very important to continue rebuilding those fiscal buffers, not deviate, not suspend the rules, because there is the energy price shock. And if measures need to be taken, again, to support maybe the most dependent or the most vulnerable categories of households or some businesses maybe that are more dependent on energy, then those measures can be implemented, but they can be very, very targeted. They can be very temporary as well. What we've seen in the 2022 episode is a number of measures have been adopted, often very costly, 2 to 3% of GDP in many of the countries that adopted support measures that were financed by deficits, financed by debt, and often not removed as soon as the crisis is abated. People like it when they get a subsidy or a cut in energy prices. It's politically difficult to remove them. So they need to be very clear rules on how they are removed. On tariffs and tolls on the transit shipments through the Strait of Hormuz, we haven't done detailed analysis on this. I would just venture that in an environment in which there is a very inelastic energy supply, I would think the incidence is on the consumers, not on the producers.
Okay, we go back to the room. I'm gonna see the lady on the first row.
Thank you for taking my question. My name is Nume Ekege from This Day newspaper, Nigeria. Given the tighter global financial conditions, what strategies does IMF recommend for African countries, especially Nigeria, to maintain investor confidence? And also, there's been a downgrade on Nigeria's outlook from 4.4 to 4.1. Can you tell us what's responsible for that downgrade? Thank you.
Okay, any additional questions on Sub-Saharan Africa countries? I see the gentleman next. Yeah.
Okay. So my name is Desmond Okon. I write for the Cable News Nigeria. So Nigeria is targeting a single-digit inflation of between 6 to 9%. Given the current global shocks, how realistic is that? That's one. All three warring countries are close to the fund. Apart from all you do and your core functions, is there any internal engagement on the part of the fund to see what they can do to potentially end the war? Thank you very much.
So on Sub-Saharan Africa, I mean, we are seeing, just very broadly, and then I'll turn it over to Denise, we are seeing some downgrade of growth, and we are seeing some uptick in inflation in a number of countries in the region. So the impact is very much along the lines of what we see more broadly, which is for a lot of the countries, especially the ones that are energy importers, but there are also energy exporters in the region, and so there is some differentiation in terms of the impact. On the fund engagement more broadly, I mean, we are certainly following with a number of countries what their needs might be in the current environment. We're certainly coordinating as well. Our managing director has started a coordination group with the IEA and the World Bank, so we're following developments in energy markets very, very closely. And of course, we're calling for a very swift end to the hostilities and a normalization in energy markets. But Denise, over to you.
Thank you, Pierre-Olivier, and thank you for the question on Sub-Saharan Africa, and in particular in Nigeria as well. So for Sub-Saharan Africa, we need to, taking a step back, actually 2025 was a relatively strong year, and before the war began, global growth prospects being resilient, and non-oil commodity prices being strong, and external financial conditions being supportive actually helped a lot of countries in the region. Now, with the war, we have reduced global growth and softened prices for non-oil commodities, and also worsened in terms of trade for oil importers, and that's an important aspect for variation within the region as well. And on top of that, the region is also facing significant challenges from headwinds from declining foreign aid, which on the bilateral aid cuts range from 16 to 28% in 2025, and we project that trend to continue. Now, how is that affecting the economy? As Pierre-Olivier said, we have a downgrade on growth by 0.4 percentage point cumulatively for 2016 26 and 27. And at the same time, median inflation in Sub-Saharan Africa is projected to go up from 3.4% in 2025 to 5% in 2026. And that's all reflecting the high oil and fertilizer prices, fuel shortages potentially, and rising borrowing costs. And fertilizer prices in particular are a concern for the region because of its dependence on agricultural products as well and existing level of food and insecurity. Now, turning to Nigeria quickly, we have revised down Nigerian growth as well by 0.3 percentage point to 4.1 in 2026, and that is reflecting a balance of two forces. One is that the war-related higher fuel and fertilizer prices and higher shipping costs that I mentioned are going to weigh on non-oil activity in Nigeria. There's some offset coming from higher oil prices, but at the end of the day, the balance is for weighing on growth in 26, with some recovery built in 2027. As far as inflation developments go, we believe that tight monetary policy and remaining data dependent and watching very carefully both exchange rate movements and inflation expectations is going to be crucial to achieve the inflation target of the central bank at this time.
Okay, we have 10 minutes and 2 regions to cover. We're going to go to the Middle East. I'm going to go first to WebEx. I see Doha in the WebEx. So Doha, please come in.
Hello, Jose. Thank you so much for taking my question. Good morning, Pierre, Petia, and Denise. Happy Easter all, and good morning for all my colleagues. I have 2 questions. My first one is the MENA region. Pierre, you have said that the impacts of the regional war will be severe on the oil exporters in the region. What about the oil importers in terms of the debt, inflation, and GDP growth expectations? My second question is a country-focused one. It's in Egypt. The report showed that the IMF has reduced its projections for the GDP growth for the country amid the ongoing war. Could you please elaborate more on that? Thank you so much.
Any other questions in the room? I see Kyle there, and then I will try to bundle another one. If it's on the Middle East, then we will go to Western Hemisphere and Latin America. Please,
Hi.
Kyle, go ahead.
Good morning, Kyle Fitzgerald with The National. Thank you for taking my question. I just want to go back to what Pierre-Olivier said earlier, that we're sort of drifting closer to this adverse scenario. So how do you imagine this adverse scenario playing out in the Middle East, both regards to the short-term and the medium-term outlook? Thank you.
Any additional question? Gentleman here.
Good morning. I'm Fabrice Nodelonga from Le Figaro, based in Paris. Could you elaborate a bit about the figures you give for Saudi Arabia? Of course, you downgrade its growth forecast, but it still should grow in the reference scenario by over 3%. How do you explain this? And can you elaborate a bit about the very severe figures you give for Qatar and Iraq? Thank you.
Yes, thank you. So, of course, the MENA region is very heavily affected, and you can basically think of, broadly speaking, 3 groups of countries. You have the conflict countries, and that includes a number of energy exporters, but really the dominant force for them is the fact that they are in the path of war right now. And that leads to a very significant downgrades and sometimes even negative growth rates for a number of them. Then you have energy exporters that are not necessarily in the conflict region. They can benefit from increase in energy prices, even though their population might also be affected by some of the effects of the energy crisis in the form of higher energy prices or potentially food prices down the line. And then you have energy importing countries in the region, and they're affected like many other countries around the world through higher their reliance on energy coming from the Gulf region, and how it's affecting both the cost of energy, transportation, and potentially down the line again, food prices. So that's kind of the broad overview. The adverse scenario would make things worse. The adverse scenario assumes that energy prices are higher than what we have in the reference forecast. It's still a relatively short-lived disruption, so we're expecting energy prices to normalize in 2027. back to around $75 a barrel for oil, for instance, but a more acute and more severe disruption. And of course, the countries in the region are going to be more severely affected. Now, on the more granular country-specific, I will turn to Petya.
Thank you. Let me start with a question on Egypt. There we have downgraded our forecast for this year in 2026 to 4.2, which is a downward revision of 0.5. And like other energy importers, Egypt is among one of the countries affected by the developments by the war, and the higher oil prices are going to reduce real income. They're going to dampen consumption, and also the uncertainty is going to affect investment. So these are the main factors behind the downgrade, which is, by the way, not only for 2026 but also for 2027. Now, when it comes to Saudi Arabia, we saw very strong growth there in 2025, which was boosted by the rebound in oil production then, as well as non-oil activities. But then this year, with the start of the war, we have a significant downward revision in our growth forecast. The revision is in the order of about 1.4. So the growth rate that we right now have for 2026 is 3.1. Now, this revision, the biggest factor behind it is the downgrade in the oil activity in the country, and that revision of the oil GDP is a little bit over 3 percentage points, so it's really sizable, which reflects the lower production, which is related to the disruptions due to the war, although there has been some rerouting, which is a mitigating factor. At the same time, we also have lower non-oil activity, as in other regions, the higher commodity prices also lead to lower real income and lower domestic activity. Let me stop here.
Okay, we're going to go through a last round, and we have a region that we haven't touched upon. It's the Western Hemisphere, and I'm including Latin America here. First of all, we have a question from Oglovo. How is Brazil positioned to deal with global shocks? I'm going to go to the room. Any other? I see my Argentine friends there. So, Paula, Guillermo, please go ahead.
Thank you. Paula Lugones, for Clarín, Argentina. The outlook revised down Argentina's growth forecast for this year. Was it because of the impact of the war, or there are some other reason? Because Argentina is an oil exporter. And also, can you please also elaborate a bit about the inflation forecast? Thank you.
We have a similar question from Infobae regarding Argentina's inflation. Very quickly, I just can get one question here, and then we need to move on, because we have literally 3 minutes.
Thank you. Hello, I'm Miguel Moscosa from El Seo, Mexico City. Does this economic outlook include an extension of the USMCA, and what other factors will influence economic growth expectations in the region? Thank you.
So Brazil, Mexico, and Argentina.
Well, let me just say just one quick thing about Brazil, and I'll turn over to Petya. Brazil is actually a net energy exporter, so it's benefiting in 2026 from the increase in energy prices. And we're expecting, however, that there will be, either through tightening of financial conditions and also increase in inflation, there might be a little bit of a slowdown in 2027. But let me turn it over to Petya for more details.
Keeping the focus on Brazil, we have upgraded our forecast for this year to 1.9. And I think this is not just because of the improved terms of trade, but also because of the very strong second half of last year and the momentum of that also carrying over into this year. It's also important to point out that Brazil is one of the countries with very high share of renewable energy, which is another mitigating factor. Then turning to Argentina, there we do have a downgrade of growth this year of 0.5, so now we're expecting growth to be 3.5. This is very much due to the weaker momentum in activity that we saw in the second half of last year, and I think that is the main factor. As you pointed out, Argentina is as a net exporter, so the positive impact of the improved terms of trade is also offset by the fact that with the higher commodity prices and the higher and the inflation that is eroding real income, and as in other countries that works in the opposite direction. Now, when it comes to inflation, we saw inflation come down from 118% at the end of 2024 to 31.5% at the end of 2025. We are expecting the disinflation process to continue, but a bit more gradually than in our previous forecast. And then finally, just a few words on Mexico, where we do have a slight upward revision in our forecast. We are expecting now growth to be 1.6 this year and 2.2 next year. Part of that, again, is because of developments that already happened in 2025. We did see stronger than expected momentum at that point. So, and on top of that, we also have the lower than expected tariffs than in our previous forecast. So that is offsetting the impact of the war. And when it comes to the USMCA, we've noted that negotiations have started. I think it's too early to evaluate outcomes and such, and this is something that we'll be doing as we have more clarity on the process. Thank you.
Thank you, Petia, Pierre-Olivier, Denise, and thank you all of you for attending this press briefing. There's going to be other opportunities during the week to continue asking questions. I want to remind you that the Global Financial Stability Report press briefing is taking place in this same room around 10:30 a.m. Tomorrow, stay tuned for the Fiscal Monitor and the press briefing from the Managing Director, and then later on the week, all those regional press briefings. On behalf of Pierre-Olivier, Petia, Denise, the Research Department, Communications Department, thank you very much. Any questions, comments, feedback, media@imf.org. Thank you very much.